A company that turned taboos into a business model. First-time care for hair loss, sexual health, skin, mental health, and then sprinted into the weight loss gold rush with GLP-1s. It hit its first profitable year in 2024 and crossed 2.5 million by Q3 2025. Then came the drama, a partnership that launched and collapsed with a pharma giant, regulatory crosswinds, and stock swings that wiped out billions in market cap in weeks. This is the full arc of Hims & Hers. This case is a study in disruption. Can a fast, digital, and low-cost model survive a war with the established giants of the pharmaceutical and regulatory industries? Hello everyone and welcome back to the Capital Navigator, the channel where we explore the history, strategies, business models, and investment opportunities of the world's most influential companies. The history of Hims & Hers is a tale of hypergrowth, exceptional gross margins, and an aggressive strategy that has propelled it to profitability, but also to extreme stock market volatility. From its founding with the goal of destigmatizing personal health conditions to its recent battle for the lucrative weight management market, this company has definitively rewritten the rules of direct-to-consumer healthcare. Get ready for a deep dive into the company that wants to put a pharmacy in your pocket. The Telehealth Revolution, the origins and rise of Hims & Hers. To understand the full impact of Hims & Hers, we must first examine its genesis, a direct response to the inefficiency, high cost, and pervasive stigma of the traditional healthcare system in the United States. The company was officially launched in 2017. It was initially founded under the name Hims Inc., with Andrew Dudum as co-founder and CEO, and a clear singular objective: to destigmatize and modernize access to treatments for personal health conditions. The primary focus initially centered specifically on men's health, addressing conditions like erectile dysfunction and hair loss, issues that historically required uncomfortable and often embarrassing doctor visits. So Dudum launched Hims, a direct-to-consumer telehealth platform that would let you consult with licensed physicians online, get prescriptions, and have medications delivered to your door. No awkward doctor's visits, no judgment, just affordable, accessible healthcare. Crucially, this direct-to-consumer approach bypassed the complexity and expense of traditional insurance plans, offering a service that was simple, highly accessible, and private. The concept was brilliant in its simplicity, and the market? Absolutely massive. The success was nearly instantaneous. In 2018, the company launched the Hers brand, focusing on women's health, which immediately diversified its portfolio and significantly expanded its total addressable market to include conditions such as mental health and dermatology. The proprietary platform they built connects consumers with licensed healthcare professionals via telehealth across numerous specialties, allowing for rapid, low-friction expansion into new verticals. For its public market debut, the company opted for an accelerated route through a reverse merger with a special-purpose acquisition company, Oaktree Acquisition. This process was key to rapidly injecting the necessary capital to finance the next aggressive phase of growth and solidify its market position. The merged entity became Hims & Hers Health Inc. and used fresh capital for two things: brand-led demand and vertical integration, affiliated medical groups and pharmacies. This pharmaceutical vertical integration would prove to be the structural foundation for the company's industry-leading gross margins. By 2022, Hims & Hers surpassed 1 million subscribers and had facilitated over 10 million cumulative telehealth consultations since its founding, a remarkable pace for a healthcare service. The year 2024 proved to be the year of validation. Hims & Hers reported a net income of $126 million, marking its first full profitable year on a GAAP basis. By the end of 2024, the total subscriber base had soared past 2.2 million. The core business: D2C platform, subscription, and integration. The operational model of Hims & Hers is not merely an online pharmacy, it is a disruptive technology platform that uniquely integrates consumer technology, medical services, and supply chain control to deliver comprehensive, direct-to-consumer care. The company has built something genuinely impressive. At its core, the company is a subscription-based telehealth platform. Most customers pay between $20 and $30 per month for continuous access to telemedicine consultations and discrete delivery of medications. Here's what makes it different. First, vertical integration. Hims doesn't just connect you with doctors and then send you to CVS. They own or partner with affiliated medical groups and pharmacies. This means they control the entire supply chain, from consultation to prescription to fulfillment. That control translates into two things: lower costs for customers and higher gross margins for the company. In fact, Hims & Hers consistently reports gross margins above 75%. That's incredibly high for a healthcare business. By the end of 2023, over 85% of orders were being fulfilled through affiliated pharmacies, which dramatically reduced costs and improved operational leverage. This pharmaceutical vertical integration allows Hims & Hers to control the supply chain from end to end. The affiliated pharmacies are responsible for digitally receiving prescriptions, compounding, fulfilling, and distributing pharmaceutical and over-the-counter products. Second, technology and personalization. The company has built a proprietary cloud-based technology platform that handles everything: customer discovery, telehealth consultations, order fulfillment, and ongoing clinical management, including a proprietary electronic medical record system that is explicitly centered on optimizing the clinical experience for both patient and provider. They're investing heavily in AI. Their tool, called MedMatch, uses machine learning to personalize treatment plans based on individual health profiles. Over 80% of dermatology subscribers get customized solutions. This personalization drives a 20-point increase in retention rates. And retention matters a lot. Hims & Hers reports an approximate 82% retention rate after 3 months. Once customers start, they tend to stick around, because switching to a traditional doctor's office or another provider is inconvenient and often more expensive. This comprehensive technological integration enables a full-service offering, from initial customer discovery on their website or app, through the consultation and fulfillment process, and finally to continuous clinical management. This end-to-end control over the customer experience is absolutely critical to maintaining the company's core competitive advantage. Third, multi-specialty portfolio. Hims & Hers isn't a one-trick pony. They offer solutions across sexual health, hair loss, dermatology, mental health, anxiety and depression, primary care, and yes, weight loss. This diversification is critical. Unlike competitors who focus on a single niche, Hims can cross-sell and upsell to existing customers as their health needs evolve. You might start with a prescription for finasteride for hair loss, then add a dermatology treatment, and eventually try their weight loss program. About 80% of Hims & Hers customers are seeking treatment for their condition for the first time. That's huge. It means the platform is removing barriers to care and destigmatizing conditions that people have historically been too embarrassed to address. The financial reality, profitability, and volatility. Analyzing the financials of Hims & Hers is to tell a story of successful transition, from a high-growth company with significant losses to a profitable, cash flow-generating platform, albeit with the inherent volatility linked to its aggressive expansion strategy. Revenue growth has been hyperbolic, increasing from $527 million in 2022 to $1.48 billion in 2024. But revenue alone doesn't tell the whole story. What matters is profitability. In 2022, Hims posted an operating loss of $69 million. By 2024, they had flipped to an operating income of $62 million. The operating line flipped as vertical pharmacy leverage and scale kicked in. Net income went from a loss of $66 million in 2022 to a profit of $126 million in 2024, a 9% net margin. This pivot to profitability was a key driver of the stock's positive performance, as it validated the financial viability of its high-margin D2C model. For the first 9 months of 2025, cumulative revenue hit $1.73 billion. But here's the twist. Profitability started to compress. Q3 2025 net income was just $16 million, down significantly from Q1's $49 million. Why? Because the company is investing aggressively in expansion. In July, they acquired Zava, a European digital health platform, to expand into the UK, Germany, France, and Ireland. They're also doubling down on R&D, launching Labs by Hims & Hers, a diagnostic testing service, and building out a new specialty, longevity. The goal is to shift from reactive treatment, solving problems, to proactive prevention, monitoring and improving overall health. The strategy is ambitious, but it's also risky, because all of this is happening while the GLP-1 controversy rages on, which we'll discuss in more detail later on. So with these numbers, there's the big question investors are wrestling with. Is Hims & Hers a screaming buy after the crash, or is it still overvalued and overleveraged? Let's look at the multiples. Forward price to earnings ratio, 80.62 with a sector median of 25. Enterprise value EBITDA, 29.47 and the sector median 12. Enterprise value to EBIT, 81.65, sector median 16. By traditional metrics, Hims looks expensive. But here's the thing. Growth companies always trade at premium valuations. The question is whether the growth justifies the price. Bulls argue that Hims is still in the early innings. They point to 2.5 million subscribers as of Q3 2025, with room to grow to tens of millions. Expansion into Europe through the Zava acquisition. The potential for renewed partnerships with Big Pharma. More on that in a second. The launch of new high-margin categories like diagnostics and longevity. Bears counter with regulatory risk. The FDA could tighten rules on compounding at any time. Litigation risk. Novo Nordisk and Eli Lilly have filed dozens of lawsuits. CEO insider selling. In October 2025, CEO Andrew Dudum sold approximately $11 million in stock under a pre-established plan. The optics weren't great. The GLP-1 War. The clash with Novo Nordisk and regulatory risk. No story about Hims and Hers would be complete without a detailed analysis of the GLP-1 war, which perfectly illustrates the tension between the disruptive telehealth model and the traditional pharmaceutical industry. Hims and Hers identified weight management, specifically using GLP-1 agonists like semaglutide, as a central high-potential growth driver. The Hims strategy focused on offering compounded versions of semaglutide. Compounding is a legal practice in the US that allows specialized pharmacies to create versions of approved drugs that are on the FDA's shortage list. Hims and Hers took advantage of an FDA shortage declaration for branded products like Wegovy, offering a low-cost alternative of compounded semaglutide through its affiliated pharmacies. In April 2025, something unexpected happened. Novo Nordisk, the Danish pharmaceutical giant that manufactures Wegovy and Ozempic, announced a partnership with Hims and Hers. They would sell branded Wegovy through the Hims platform at a discounted subscription price of $599 per month, which included the Hims subscription. It seemed like a win-win. Hims would get access to the legitimate FDA-approved product. Novo would tap into Hims' massive direct-to-consumer distribution network. The collaboration was hailed as a fundamental milestone. It lasted exactly 1 month. The collaboration ended abruptly by decision of Novo Nordisk on June 23, 2025. And they didn't just walk away quietly, they went nuclear. Novo accused Hims of failing to adhere to the law by engaging in the mass sale of compounded drugs under the false guise of personalization. They claimed Hims was selling illegitimate knockoff versions of Wegovy that posed patient safety risks. Hims fired back immediately, calling Novo's accusations misleading and claiming the pharma giant's real motivation was controlling clinical standards and directing patients to Wegovy to protect its monopoly pricing. The financial impact was immediate and devastating. The Hims stock plummeted by over 34% in a single trading day. Over $3 billion in market cap evaporated. The stock drop led to investor securities class actions against Hims, alleging that management failed to adequately disclose the regulatory risks associated with its marketing and compounding practices. The incident created a narrative that Hims might be selling potentially risky copycat drugs, which affected consumer confidence and generated intense media scrutiny. But here's the crazy part. It got worse. Novo Nordisk didn't stop at terminating the partnership. They filed over 130 lawsuits against Hims and other telehealth providers, alleging patent infringement and illegal compounding. Class action lawsuits from investors followed, claiming Hims had failed to disclose the regulatory risks of its GLP-1 strategy. Then came the regulatory hammer. On February 21, 2025, the FDA officially resolved the semaglutide shortage. The legal justification for Hims' compounded GLP-1 business, the shortage exemption, was gone. And if that wasn't enough, in October 2025, President Trump announced his intention to drive down GLP-1 drug prices to as low as $150 per month. If brand-name drugs became that affordable, Hims' entire competitive advantage in the weight loss space would disappear. By November 2025, the stock had collapsed 53% from its all-time highs, falling to around $37.70. The company that had been valued at over $10 billion in market cap saw that figure slashed by more than half. Following the fallout, Hims had to reevaluate its reliance on high-margin GLP-1 compounding. Hims continued to sell compounded semaglutide while it was legal, but began to aggressively promote generic liraglutide, which is legal, available, and a GLP-1 agonist, though less potent than branded semaglutide, as a low-cost option in its weight loss portfolio. To mitigate regulatory risk, Hims accelerated its strategy to pivot toward longitudinal care and prevention, including the launch of Labs by Hims and Hers, diagnostic testing, and expansion into the specialty of longevity. However, by the end of 2025, CEO Andrew Dudum announced that Hims was back in active discussions with Novo Nordisk to offer both Wegovy injections and, crucially, Novo Nordisk's future oral pill through its platform once it receives FDA approval. This renewed discussion reflects a clear interdependence. Hims needs a legally defensible branded offering, and Novo Nordisk needs a solid distribution platform with a large and loyal customer base. The materialization of a new agreement would eliminate the legal uncertainty over the supply of a leading GLP-1 product and confirm that the weight management segment has a clearer path for future growth. The challenge, however, will be whether Hims can maintain its high margins by moving from selling compounds with low input cost to selling branded products with high wholesale costs. Hims is acutely aware that it can't rely solely on weight loss drugs. That's why they're aggressively expanding into other categories: labs and diagnostics for proactive health monitoring, hormonal health, menopause, low testosterone, longevity, and preventive care. The company has set an ambitious long-term revenue target of $6.5 billion by 2030. To hit that number, they'll need to execute flawlessly across multiple specialties. The Zava acquisition is a big deal. Europe represents a massive untapped market, and Zava already has established operations in key countries. If Hims can replicate its US playbook internationally, the growth runway extends significantly. So here's the truth about Hims and Hers. This is a company with a genuinely innovative business model, massive market opportunity, and impressive financial execution. They've achieved profitability, built a loyal subscriber base, and demonstrated the ability to scale across multiple specialties. But they're also navigating existential regulatory risks, litigation from Big Pharma, and intense scrutiny from the FDA. The GLP-1 controversy exposed the fragility of their fastest-growing segment. One thing is certain, this story is far from over. Whether Hims and Hers becomes a cautionary tale of regulatory overreach or a blueprint for how to disrupt Big Pharma, we're watching one of the most fascinating business battles of the decade unfold in real time. What do you think? Is Hims and Hers the pharmacy of the future, or is it a company destined to be crushed by the industry giants? Let me know your thoughts in the comments below. If this deep dive helped you understand what's really going on with Hims and Hers, hit that like button and subscribe to the Capital Navigator for more analyses of the companies changing the world. Thanks for watching. I'll see you in the next one.